Hello and welcome back. I'm here again with Sarah Dorsey, CPA, to hopefully navigate us through some end of year tax strategies. We have a lot of things going on here in the Northeast. We got our first two snowstorms, and so sometimes people navigating their taxes at the end of the year can be just as tricky as navigating the roads when there's some snow in there. So hopefully we get some helpful pointers. So Sarah, welcome on to the podcast again, and happy to sit down and chat.
Thanks. Yeah, me too. It's great to be back for round two.
And you had put together something before our talk today that is a nice, helpful guide that I think that you sent out to your clients. And what I'm hoping to do is give some people some takeaways as far as things that they can do before January 1st, 2025. I can't believe I'm saying that. It's already another year gone. But before that calendar flips, what are some things that are should be top of mind for people as they are trying to plan for filing their taxes next year?
Yeah, sure, absolutely. I know I felt the same as I was putting together that newsletter. I'm like, oh my God, another year gone. Every year I say it, and I think it's probably just a factor of getting slightly older every year.
Yeah, you can't fight father time.
No, no, that's true, right? Death and taxes.
Let's avoid one of those for a while. So
Yeah, so leading up to the election, honestly, all politics aside, I was a little bit worried about what was going to happen this month. Really, there was some increases on the table that I think would have potentially caused a lot of people to make quick decisions that may not have been in their best overall interest, but really just to save on taxes.
and those were related to the Tax Cuts and Jobs Act from what was it 2017, right? Those they were scheduled to sunset.
Yes, yep. So they're scheduled to sunset at the end of 25. And the Tax Cuts and Jobs Act, that was enacted during Trump's first term. So we would expect a lot of those savings to hopefully continue now that he's been reelected. But there was also talk of increasing in capital gains rates, some unrealized gains potentially being taxable. So that was some of the scary stuff that my clients were looking at, and probably yours too.
Yeah, the idea of taxing unrealized gains, I don't think that sat well with a lot of people.
Right.
And it was from an implementation standpoint, I wasn't even sure how they would go about that. So,
Hmm.
yeah, like you said, it provides a bit more clarity to the tax situation. Again, all politics aside, it I think is going to be a bit more straightforward as far as what the path looks like for people with their taxes.
Yeah, yep, absolutely. One area I do think is going to change going forward will be energy incentives. The current administration has been very heavy on electric vehicles, reducing emissions, those kinds of things. And to try and help that cause move forward, they've been providing tax incentives for electric vehicles, solar panels. President-elect Trump isn't on necessarily that same path. He's more about getting energy produced in the United States, as opposed to eliminating a lot of that energy items. So
So
I
go buy your Teslas now.
pretty much exactly get your Teslas, get your solar panels now, just in the event those are going away next year.
Yeah. And
Yeah.
that's obviously a big consideration, especially if you were planning on going that route already.
Hmm.
And I think that that is a good segue into kind of an overarching theme as we talk about taxes and what you can do. I think a lot of people fall into the trap of doing things just to save taxes, right?
Hmm.
I wouldn't recommend installing solar panels on your house just to save taxes. It has to make sense for you and your situation.
Hmm.
Same thing when it comes to like business deductions. I wouldn't say go buy a new vehicle so that you can write it off against your taxes for the year. Like, do you need a new vehicle? Because I think people equate saving taxes to saving money sometimes.
Yeah.
And that's not always the case because, yeah, you might be saving cents on the dollar in your taxes, but you're still spending that dollar from your bank account.
Right. No, that's such a good point. Yeah, I think there is people tend to forget it's really only a 30-cent savings, right? Not a full dollar savings. So unless you were intending to do it to begin with, the rushing out to do it just to save taxes isn't necessarily the best overall plan. And I think that kind of goes into the way I look at just overall planning with clients in general is, well, what's your end goal? And typically, it's not always, it's not really ever just to save taxes. It's more to, I want to provide for my family, or I want to pass wealth on to the next generation, those types of things. And then we meld the tax planning into that overall goal.
Yeah, it's the classic don't cut off your nose to spite your face. Like, don't do something just to save taxes because you hate taxes so much. You want to be maximizing your bottom line throughout all of this.
Yes, yes, exactly, exactly. Yeah, and I think that kind of goes into play where we talked about on our last podcast with like Roth conversions. Those are it's something that can be done in a low income tax year. So if you're in a lower bracket this year and you have some retirement funds that could potentially be converted into a Roth, this might be the year to do it. We're not expecting to see that go away, but before the end of the year, you might want to take advantage of that to preserve future wealth for your retirement. A Roth is non-taxable when you withdraw it, so you might recognize some taxable income this year, but in future years, you or your heirs won't have that taxable income, and you'll have that tax-free growth also
Yeah.
built in.
You mentioned the low income. That's such a key point to that. If you're already drawing on your required minimum distributions and you're already paying taxes at your ordinary income rate at potentially higher rates versus a low income year where you're drawing more on taxable money, savings accounts, there's going to be that sweet spot post working years, pre RMD years that's the best time to do those Roth conversions because you're taking advantage of those lower taxable income years. What are some other things that somebody's in a low tax bracket for this year? What should they be thinking about before the end of the year?
Yeah, another thing to think about would be what kind of capital gains you have. We usually don't hear much about accelerating recognition of those capital gains, but right now we're in a great place for long-term capital gains taxed at 0, 10, or 15%. So married couples with taxable income of up to $94,000 have the potential to recognize long-term capital gains at 0%. So that's a great benefit of being in a low-income year is recognizing those capital gains now, getting some liquidity, and paying almost nothing on them.
And that's, as you said, not a lot of people think about capital gain harvesting.
Right.
Everybody's probably read an article or two about capital loss harvesting.
Mm-hmm.
And we're lucky enough to have the last few years in the stock market where there's not a lot of losses to harvest.
Right.
And we wouldn't necessarily recommend a capital gain harvest strategy if you're in a higher tax bracket. But if you are in a lower tax bracket, again, this comes back to being intentional about paying your taxes.
Mm-hmm.
Some people avoid taxes like the plague, and by doing so, they're inadvertently putting themselves into higher brackets later on in life because they're not taking advantage of maybe some lower tax years, right?
Right. Yeah, exactly. I know, and I've had clients, probably you have too, who've just been surprised at how much tax that they pay in retirement, and maybe they may not be in a position to pay those taxes as they were when they were working and having it withheld from their W-2s and that type of thing.
Mm-hmm. And that's, I think from people in low income years, the Roth conversions and the capital gain harvesting, those are two major areas to look at.
Mm-hmm.
On the flip side of the coin, people that are in higher years, whether they're currently working or maybe they have already started their required minimum distributions, what are some things that people can do to hopefully limit the blow from Uncle Sam in April?
Sure. Yeah. So a couple of other things, and this isn't necessarily before end of the year, but if you have your if you're in a high deductible plan, I would definitely consider maxing out your HSAs. I call those kind of a triple whammy. You're taking that money, you're getting a tax deduction when you put it into your HSA. It's growing tax free, and then if you're using it for a qualified purchase, you're taking it out tax free. So that's kind of a triple whammy.
Yeah, I love HSAs. And just to clarify, those are health savings accounts
Yes.
for those that don't know the acronym. But us in the financial community, I think that those are the most recommended slash talked about financial vehicles to maximize the benefit or to pay the least amount of taxes, because
Mhm.
every other account you're going to either pay taxes on the way in or pay taxes on the way out or pay taxes during the entire time that you're holding them on interest and capital gains. It's the only thing that exists where you put it in tax free. And benefit too, if you're doing it through payroll deductions, is you're saving on the Social Security and Medicare
Mhm.
aspect as well, right? That's
Absolutely.
if you have that benefit through your employer to take deduct it from your paycheck, you're saving on Social Security and Medicare taxes on the way in as well.
Hmm.
And then it grows tax free and then it comes out tax free. One thing that I don't think a lot of people are aware of while we're on the topic of HSAs
Sure.
is, well, what if I don't have medical expenses that are going to amount to the amount of dollars that I have saved in the HSA?
Hmm.
I don't think a lot of people know that at age 65, you can take money out for no medical expenses. You do have to pay the income tax on the way out in that situation, but it gives you the added flexibility, right?
Absolutely, right. It's not like a I'll use it or lose it type thing either. The growth is still tax free on that. And it right. Once you hit 65, you take it out, and you consider it almost like another retirement account as
Yeah.
opposed to a health savings account. I think another thing I qualify an HSA as is converting, previously non-deductible medical expenses to a deduction. I've had situations where clients don't necessarily pre-fund the HSA, but they've incurred medical expenses of, let's say, $5,000 throughout the year. You're not going to get an itemized deduction for those for two reasons. One, there's a threshold you have to meet, and two, the standard deduction is so much higher. You can deposit funds into an HSA and then just reimburse yourself for that expense. So you're net zero, right? You haven't really incurred any extra cost, but you've converted that now to a tax deduction where you wouldn't have previously had that.
That's a great strategy and one that I don't think a lot of people are aware of. All it takes is really just shuffling some paper around, electronically sending money here and there, and then you're saving on the taxes by doing that extra step versus paying out of pocket and not saving on the taxes for money that you're paying for medical expenses.
Right, right, exactly. Yeah,
But
yep.
just to confirm also and clarify,
Hmm.
you have to be enrolled in a high deductible health plan in order to contribute.
Correct, right. And
Related to that, sorry.
yep. Oh, no, that's okay.
Related to that, the people that maybe are working and have the flexible spending accounts, I would
Hmm.
say look at the amount that you've used so far, look at the amount that you've scheduled to put away for the year. And if there's a difference and you have extra money put away, now is the time to start looking at spending money
Hmm.
on your medical expenses. And that might be medical supplies if you're not planning on going to the doctor, and making sure that you're not losing it in that case, because different from the HSA, those flexible spending accounts are going to go away when that calendar flips.
Right, right, exactly. Yeah, and I think of some like expenses that may not be top of mind. Eyeglasses are one of them. It's not necessarily a prescription or a doctor visit, but if you wear glasses, use it for something like that. Even prescription sunglasses might be another option to think
A nice
about.
pair of Ray-Bans.
Yeah,
Really treat yourself.
some Oakleys.
So good. And in other areas where people who are in the higher income years,
Mhm.
what can they do before the end of the year where they can start to save on those taxes?
Sure. Yeah, another thing I typically advise clients on, especially, we have business owners, but we also have real estate investors who may be using their kids to do some filing for them. Maybe they're increasing their social media presence, popping their stuff up on Airbnb. Think about paying your kids. What that's going to do is shift income out of your higher tax bracket into their lower tax bracket. For federal purposes, you can pay your kid $14,000 without them recognizing any taxable income. For New York State, it's about 4,000, so it's a little bit of a difference there. Um, but this is a great way to shift wealth down to your kids. You get some tax benefit of it, and they also have the ability to then take that money and pop it into a Roth. So now they're getting the benefit of having funds, no tax to you, and in their bracket or in their retirement account, no taxable income to them, tax-free growth and tax-free withdrawals later on down the road.
Yeah, kickstart those Roth IRAs. Is there an age limit for, I mean, if you tried to claim that your 2-year-old is helping you file, that's not going to fly, right?
That's not going to fly. It definitely has to be a reasonable. But I do have some clients that have kids that are models for them for their websites potentially. So, you know, that's an option. You just want to be reasonable about it, and you want to pay them a fair wage. You're not going to give your kid 50 grand to do your filing for you.
Depends on how good looking they are if they're the model,
Well,
right?
that's true. Yeah,
They might
exactly.
demand a higher. I've seen the agents for these kids.
Usually it's the other spouse, right?
Yeah, yeah, for sure. And we touched on it a little bit before too, with regards to the tax gain harvesting. The flip side of
Mhm.
that is looking for losses to harvest.
Right. Yep.
And this is, I think, one of the more misunderstood things when it comes to investing and how it relates to taxes, because everybody is like so keen on recognizing losses to offset their taxes. Back to my earlier point, you don't want to do it just to save taxes. Like if you sell out of something, you have to wait 30 days to get back into that investment. So if you like that investment,
Right.
why would you sell it? And the idea of the loss harvesting, you can't sell out of an S&P 500 fund and buy another S&P 500 fund. It's the same thing.
Hmm.
So, A, there's not a lot of losses to go around this year and
Yep.
based on this year and last year. And if you are moving to a similar investment, you run the risk of the investment performance not being the same as the investment that you were previously in. When I describe tax loss harvesting to people, I use the example of Coke and Pepsi, right? If you
Hmm.
have Coke, it's at a loss. You sell it, you buy some Pepsi so that you're not missing out on any return. But that ignores the fact that there's a potential that the Pepsi or the Coke could diverge in performance in that short period of time. So you want to be careful if you're going the route of tax loss harvesting and not doing it just to harvest the loss, but also being smart about where you're reallocating that money to.
Yeah, no, I think that's such a great point and goes back to the cutting off the nose to spite your face analogy. Yeah.
Yeah, and it's again, people are so keen on not paying taxes. I would
Hmm.
much rather pay taxes for something that I profited from instead of harvesting a loss and then missing out on any rebound in performance. So I'm
Right.
kind of in the middle when it comes to tax loss harvesting. There's ways to be smart about it, and that's a whole separate conversation. But if you do have something that you're looking to get out of and it is at a loss, maybe take advantage of that by the end of the year so that you can write it off against your gains for the year.
Yeah, well, I think it goes back to just kind of being more aware and of your holistic approach too, right? I think some people run into a situation where they're just not paying attention, or they have an advisor that's not necessarily paying attention to things they could be doing, and maybe something has been sitting at a loss for years, and you don't even know you have it. So I think that's where somebody like yourself really comes into such a benefit. Just reaching out to somebody to say, hey, you know, you've had this for a while. This might be a good year to take it.
Yeah, definitely.
Yeah, for sure.
What else in regards to lowering taxes? I know charity, especially we're in the
Hmm.
giving time of the year, and charity is at top of mind for a lot of people. How can people be smarter about giving money to charity so that they're saving on taxes as they're donating to their favorite causes?
Sure, yeah. You know, I think you know, I don't know, I haven't really looked at the statistics of this, but I do feel like charities have probably suffered with the increased standard deduction. Um, because you know some people give out of the goodness of their heart, other people give because they get a tax benefit from it, right? And with that increased standard deduction, some people aren't getting the same benefit that they saw before.
And
But I
just for people that are unaware, what are the limits for claiming charitable deductions on your taxes?
The limit for it's 50% of your gross income. So you can actually it's up to 60% now. So you can give 60% of your income to charity and take a deduction for it. but
And
you're
then
still,
on the low end, you said the standard deduction kind of eliminates the need to itemize. So
right.
if you are itemizing, is there like a threshold that people have to hit where it makes sense and the dollar amount of that standard deduction?
Yeah, yeah, for a married couple, you really want to be over $30,000 of a charitable donation,
Yeah.
to get any benefit, any tax benefit from it anyway. Um, but one area I see that people miss out on is the qualified charitable distributions from your retirement accounts. So if you're um, in a position where you're about to take your RMDs and you're charitably minded, I would recommend having that retirement distribution go directly to your charity that you would like to benefit. That reduces your gross income. It's not an itemized deduction. It's just direct reduction of your total overall income.
Yeah.
So I think that's one area to be mindful of, to reduce your overall taxes and to keep benefiting those charities.
That's the biggest part is the charities see the benefit.
Hmm.
Obviously, you want to be saving on taxes if you are already going that route.
Right.
But if you're not charitably inclined and you're just thinking about ways to reduce your taxes, that might not be the best option for you, but it wouldn't be the worst thing in the world if you decided to give money to charity because then they would benefit from it.
Right, right, exactly. Another thing to think about too would be like a donor advised fund. So maybe you want to give $30,000, but you're like, I don't know if there's one specific charity I want to give $30,000 to at this point. Pop it in a donor advised fund. You get the deduction right now for, let's say, $30,000. And over the next 5 or 6 years, you can decide where you want that $30,000 to go.
And that is there time limits on the distribution to the different charities once you contribute to one of those funds?
No, no. So what happens is like let's say like a community foundation holds it, invests it. That nonprofit community foundation benefits from the earnings of the assets that they're holding, and then just as you want to, you direct where those funds go.
Fantastic.
Yeah, hmm,
Well, I think we covered a lot of bases
I
in the
think so
talk
too.
today. Are
Yeah.
there any other areas that is an absolute necessity or something that people should be thinking about in this next month?
Yeah, the only couple of other things that pop up to my mind are gifting, your annual gifting strategies. So you want to make sure if gifting is part of either your estate plan or just your heart. You can give a certain amount to any individual. $18,000 is the amount for 2024. Excuse me, 36,000 if you are married. So you can give that to anybody. There's no taxable um, income to that recipient, and there's no requirement to report it to anybody. But just those need to be done before December 31st in order to get the annual exclusion amount. I would keep that in mind. And then also funding your 529 plans. That's another big one that has to be done before December 31st. So it's not, an IRA you can fund up till April 15th, not a 529 plan.
And just a quick note on the 529 plans, they do have a special situation for that gift tax limit exclusion where you can front load 5 years worth of contributions into 1 year. So if you've
Exactly.
come into maybe you had a stock sale in your company or just you're sitting on a pile of cash and you have the idea to give money to your kids via the 529, there is that special limit where you can do the 5 years at once, up to 5 years that limit, right?
Yep, yep, exactly, exactly.
So that's fantastic advice, and it's always helpful to have an expert in your corner. Very appreciative of you coming on here to talk through with our clients or the people that need to hear this kind of stuff before the end of the year. Is there anything else that you wanted to touch on before we sign off?
No, I think I'll just say one more thing is the Corporate Transparency Act that was enacted for 2024 this year. There's a new filing requirement for LLCs and corporations. So business owners, but also real estate holders. If you have property held in an LLC, there is some new filing requirements with a financial board called FinCEN. There is some question about the constitutionality of it, but I just think people need to be aware that you may be required to file by December 31st. of this year or face some tough penalties.
Well, that's always helpful to know.
Yeah, not to end on a negative.
You're not trying to go to tax jail here, so make sure you file all your taxes and file all your
Your
forms
taxes.
correctly.
That's right.
Yep.
That's right. Exactly. But no, it's been a pleasure. I enjoy working with you guys, and it's great to have you available to me too to bounce some items off of when I have questions that pop up.
Well, I'm sure we'll be doing this again soon. So thanks again for coming on, and we'll talk soon.
All right, sounds good. Thanks,
All right,
David.
take care.
You too.